Hello traders, welcome to yet another lesson. So how do we define our daily bias? So from the understanding of defining the weekly bias, we're just going to be dropping into the daily chart and now do the same thing, but now from that direction that we've determined in the weekly is what we're going to be using now down in the daily chart. So that same bias, it's what you're sticking with, because the weekly chart will provide an opportunity to maybe get a picture of maybe the next 3 or so months of where the market is going, and the daily chart will just follow what the weekly chart is doing. So daily bias is essentially, once you determine the weekly bias, the daily bias actually can be easily anticipated, because given that each day of the week makes up one weekly candle, so 5 trading days make up one weekly candle. So those days, they'll just be the same thing. What the weekly is doing is what the daily will be doing, but it's just expanded into 5 trading days. That's the only difference. So looking again at the daily range, the typical daily range will include the open, just as we learned in the weekly range. It will include the open. So in this instance, the daily range, we're going to be using the midnight open. It will also include the low, the high, and the close. So this is the close of the day. This is a typical daily range. So I've outlined an example here. This is the midnight open. So this is typically what you'll be expecting to see. So the anticipation of the daily range is actually crucial in knowing how we are supposed to trade for the entire day ahead. So it will help us if you're day trading, scalping, or even doing swing trading and you want to position yourself. The daily range can really help you and assist you in positioning yourself. So first of all, before the day begins, you have to understand what the previous day's data looks like and where it is coming from, and which key level has been hit in the previous day in terms of which fair value reference point has been hit. It could be a fair value gap, it could be an order block, or even some form of liquidity that has been taken out. So this process actually is important for you to anticipate the likely direction of the day ahead. So I've actually outlined an example of a daily bias where I've started from the weekly chart. So the weekly chart, already we've seen that this is a 1 week chart. We hit that monthly imbalance, and then we created this weekly imbalance. So from that weekly imbalance, we could be watching either one of those days that we outlined in the weekly bias, Monday, Tuesday, or Wednesday, where it will come and hit that imbalance, and then we'll see we are expecting a response from that area. So we'll go deeper into the daily chart and see how those days were printed, probably maybe this week and the next week, how they were printed and how they are heading towards this target. So in the daily chart, we see that it came off this monthly imbalance. So you're seeing it, actually order flow is being respected, taking out highs here, and you're seeing that the weekly actually came back to this imbalance and started respecting this imbalance. This is the daily imbalance, and we're seeing actually it started respecting even order blocks. Then it's going higher and higher. So it is actually going for that weekly target. So the daily chart, the bias in the daily chart, for instance, if you are in this day and the market comes back to retest that order block, then it means that this day is from here within the weekly bias, you are anticipating higher prices. So you can actually see how many high days or bullish days we had as the market was drawing towards this target. So looking at the midnight open, this is the price that occurs every day at midnight. And when I talk about midnight, I'm talking about UTC, New York time. So this is a very key reference point in determining if our daily bias will be respected or not. So once you have outlined your midnight open, you want to see price actually come maybe up if you're bearish, come up above the midnight open and then collapse below, creating that range of the day, just like we have outlined that there's a range of maybe open, high, close, and then maybe the low and the close. So that's the same thing you're anticipating using the midnight open. And you can see how sensitive that price is once it hits. So this revisited during New York, it hit and then continued low. And then you want to actually outline this midnight open in the 15 minutes chart. So when you're bullish, you want to see the market actually trade below the midnight open, either during London or New York session. So essentially, if this is a bullish day, if you have outlined the midnight open here, you want to see the market come down, hit a higher time frame. Actually, that's very important. That's the most important part of it. Hit a higher time frame, either order block or fair value gap. So in this day, it hit this bullish order block on the daily chart. Then it hit it during New York, and then we see this expansion. So, but typically, you want to see this occur during London. Most of the time, you see it occurring during London session. But essentially, you can also find it in New York session. So you want to see a reaction once it hits this, and then away from that level to create that bullish day. This is an example of a consolidation day, just like we saw the weekly consolidation day. So if the market remains near or at that midnight open during the entire day, or at least you can see it maybe late New York is this region here, between 10 to 12, it is still coming back below and you're expecting bullish prices, most probably that market will consolidate that throughout that day. So once it came back here, this was an indication that this market might not really rally anywhere, especially if we've hit the 12 p.m. mark. So price kept just hovering just near that midnight open. So that's how you can anticipate a consolidation day. So how do you define your daily bias? Again, we'll be looking at another example, a live example, so don't worry. So the first thing you want to do every day, you want to determine the likely direction of the day. But the first thing you should have done is defined your weekly bias. So once you have your weekly bias, then you can come to the daily bias. So the daily chart will follow the monthly and weekly direction. So once you have that weekly bias, you drop to the daily chart. So what you do in the daily chart, you define whether you're on a premium or a discount relative to that weekly bias. And we've already looked at how you can define premium and discount. You can determine a range in price, or rather a price range, and then you can look at where the equilibrium is. Then you will find premium and discount. So and then you can use now fair value reference points to determine whether we are in a premium or a discount. So those fair value gap reference points we have already outlined, the fair value gap or the order block or the liquidity being taken out. And then the market will now move from premium to discount and from discount to premium as it fulfills the monthly and weekly directions. So you'll just keep track of what the daily is doing relative to that weekly and monthly chart. So every day we will have different biases depending on where price is. And then you want to identify any liquidity available in the direction of the weekly bias. So this will be your potential targets. So look for market structure shifts toward the weekly chart. And then look for signs of bank sponsorship where you're seeing imbalances being left in the daily chart. Then order flow should be maintained in the direction of the weekly draw. Order blocks, or rather new order blocks and fair value gaps, should be created and confirmed towards that monthly and weekly direction. So once you see your targets are hit in the monthly and weekly, redefine your daily bias. Because once the targets are hit, then you should be done and wait for another opportunity for a clearer bias in the weekly chart. So you will be looking at each day, annotate your anticipated daily direction at the beginning of the day and record the actual delivery at the end of the day. Then record in a journal what you anticipated and what the market actually did. Then follow the process outlined in this lesson to annotate and probably analyze. So thank you so much for watching. A live example is up next. Thank you.